purchase order finance, it's actually quite an old style of trade finance. Way back when you were shipping from Asia and Europe, there were loads of goods that were being financed by banks, trade banks, and in essence, those banks were sort of taking on the risk of the deliveries based on the end buyers. We do very much a very similar scenario where you have end customers that have the credit to pay for the goods. However, a company here, for instance, in the United States, may not have the liquidity or the capital or balance sheet to support the purchase and delivery of the goods. We simply take on a performance risk that a traditional lender may not take. What I mean by saying performance risk, we are taking on a risk of the sale going wrong, and so our discipline is really to identify people that have firm orders and have the abilities to fulfill those orders if they have the capital to do so. It's really prior to factoring. Factoring is an advance upon a receivable once goods are delivered and you fulfill the obligation. This is a different risk. This is prior to the obligation being fulfilled. This is the aspect of which you have an order in hand and the buyer says, if you could deliver it by a certain date, the quantity and quality and at a price that I'm willing to pay, then you have a receivable which a factor can advance upon. We're advancing or putting out credit prior to the goods sometimes even being started in wherever they're being manufactured. They could be manufactured in the United States. They could be getting manufactured in Asia or Europe, South America. So we're really taking on the risk of the delivery, often the production being done properly. I mean, we could finance a business of almost any size. When you say constraints, really, I mean, the challenge, the constraints might be that much more related to, do you have customers that can afford to pay for the goods? So that's a credit constraint. I mean, and that wouldn't be unique to us, but we would look at that more closely, perhaps, than a traditional lender may not be looking at it like we are, because we have to look at, will this transaction or group of transactions or orders, if you bring the goods in, can they pay for them? It's not unusual for companies that don't have good credit to place large orders. And so sometimes you have to look at it and say, okay, we know we can finance or pay for goods and get them to the customer, but can the customer pay? So that's sort of where it starts. Other constraints are not unusual to any type of delivery of orders for any company. I think that often they feel it's equity, pure equity, meaning they think we're willing to take the ultimate risk of loss while not charging very much for the financing. And purchase order finance is an excellent manner to finance fulfillment of orders and growth in a business by not giving up equity, but we're not pure equity. So we do have a lot of people that approach us with really they're out raising equity for a startup. Back to the comments on startups, and the startup doesn't really have a history, and it's doing something brand new, and it's a new industry or it's a new idea. That's not necessarily what we do. We do see companies that I think the misconception is we're just willing to, take any risk. Well, I think it's kind of refreshing when we talk to, people that are manufacturing something or having it manufactured. Our first questions are really, tell us your opportunity. We want to understand the opportunity. We want to understand what it is that they need to fulfill the opportunity. So we actually dive into more operational granularity of the delivery and fulfilling the orders. And we will dive into what are the economics of the order. Are you buying a widget for $1 and selling it for $2? And who are you selling to? Because that's really the crux of business and where people make money. We know for the most part when we're being contacted, for the most part, the company has determined, talking to their bank or asset-based lender, that they don't the opportunity doesn't fit in their borrowing base, or they just don't have the balance sheet. So we really talk more about how do you get it from it's an order. What is the trade cycle to fulfill that order? Is it, you have a manufacturer in China who is going to build it, and it's going to take 45 days, and then it goes, shipping company picks it up and put it on the water, and it's going to be, well, used to be 18 days, now it's 35 days, however long. And then, then it's going to be delivered to your end customer, whoever it might be, good credit end customer. And what is their requirement to accept the goods, to turn it into a receivable, which is, eventually paid.